everyone. Welcome back to In Her Wallet, a weekly podcast helping women around the world take control of their finances for good and build better financial futures one episode at a time. My name is Sofiia. I am an accredited investment representative here in Canada, the founder of In Her Wallet, and the host of In Her Wallet podcast. Last solo episode that I did was about the four strategic ways to use your tax refund cash so that you can set yourself up for a solid financial future. That episode got quite a few downloads and views, so I decided to boldly assume that this is the topic you guys like and create an episode also related to taxes. And today I'd like to talk about how to legally pay less tax in Canada. Taxes are one of the largest expenses we accumulate throughout our lifetimes, especially if you live in an expensive country like Canada. And while you have to pay your taxes, which I hope you do, because otherwise it's a bit of an issue, but while you are legally obligated to pay taxes, there are a number of legal ways to reduce your tax bill. I saw that firsthand when I used to work in wealth management with individuals and families who obviously had their wealth built up throughout generations and many, many years. But I saw how they were applying those tax strategies to make sure that they are keeping portions of some of the income that they make for themselves. And I know that these strategies can be applied to people like you and me, people in their 20s and 30s who might not be as wealthy yet, but who definitely have a goal of getting on path to financial success and independence and stability. Before we begin, I want to do a quick disclaimer and let you know that the content I produce is for educational purposes only. This is not financial or accountant advice. If you do want to have advice related to your specific situation, I recommend you to seek the help of a professional in your region, country, wherever you're located. So that also applies to your local laws and regulations. All right, without further ado, let's dive in. So, before we discuss the three ways you can legally pay less tax here in Canada, first I want to discuss how the income tax is calculated. I think there are a lot of myths around that some of my friends share as well. So, I want to address that first. A lot of people believe that the more money you make, the more tax you pay, and the less money basically is left in your bank account and is left for you to use personally, meaning that people do not want to perhaps receive a $5,000 raise if that moves them into the next tax bracket because they think that they will actually be paying more taxes and be left with less money. This is not true and this is not correct. And the reason for that is because we here in Canada, as in many different countries, use a progressive tax system. What a progressive tax system means is that the income you earn is divided into different brackets. Each bracket is taxed with its own percentage. The higher the bracket, the higher the percentage. But it does not mean that the more money you make, the less money you have left for yourself and the more money you're giving away to the government. Let me give you an example to illustrate what I mean. Let's imagine that you are a person, an employee working for a company, and your annual salary is $60,000. You live in Vancouver, in British Columbia, very lucky, but you are paying a lot of taxes. Here's what I mean. If you're an employee, that means that you fall into a 20.5% federal tax bracket and 7.75% provincial tax bracket for a total of 28.2% of tax. A reminder that in Canada, we pay both federal and provincial tax. Both of those are multiplied, and you calculate that cumulatively. So if you have that 28.2% tax bracket, it doesn't mean that you're paying 28.2% on that full $60,000 amount every year. What it actually means is that for the first 50,000 bracket, you fall into a 15% tax bracket and you're only taxed 15% in federal taxes on that 50,000. The next tax bracket is the next 50,000, which is taxed at 20.5%. And then the next tax bracket, the next 50,000, is taxed at 26% until you max that out as well. So again, if you're in a $60,000 salary range, you pay 15% on the first 50,000, and for the remainder $10,000 that you left, you pay 20.5%. So do you see now how it's split by the brackets and what I mean by that? Perfect. So, and that's only in federal tax, right? Provincial tax works in a similar manner with different tax brackets and rates, and then you add those up, two percentages up together to arrive at the final number. I won't go into provincial tax details here, but I hope you grasped the concept and you now understand that if you were offered a raise and if it moved you up to the next tax bracket, it does not mean that you are now earning less money. You are earning more money, but the portion that is exceeding the tax bracket that you're currently in and falls into the next one, that's what taxed at a higher tax rate. Okay, now that we have covered the basics, let's move into how you can reduce your tax bill. The easiest way to reduce your taxable income is through retirement contributions. You probably have heard of this before, and it's not a secret for you that in Canada we have a vehicle called Registered Retirement Savings Plan. An equivalent in the US is a 401k. The idea behind an RRSP is the following. If you are an employee working for a company, you get taxed straight as that money comes to you from the employer, meaning that the money gets taken away before it gets deposited into your checking account. So you don't even get to see a portion of your money that you earn. But with a registered retirement savings plan contribution, you're able to put a portion of your income before it's taxed, before it comes into your account, before the company processes that into an RSP. And then you will be taxed on the remaining amount. Basically, you pay less tax because your taxable income is less now. And it's also a win win situation because you get to put a portion of your pre tax dollars towards your retirement that also gets to compound and grow over time. Oftentimes, a very good point about RSPs is that the employer will oftentimes match your contributions, meaning that they will contribute an equivalent amount of your match to your RSP account. If you put $50 to your RSP every 2 weeks, and if your employer offers a matching version, they will also put $50 to your RSP from their end, meaning that every 2 weeks you have $100 going into your RSP towards your retirement. Isn't that great? You're probably thinking all of this sounds way too good. And unfortunately, yes, there is a small trick in this situation. With RSP accounts, the contributions that you make, unfortunately, are locked until your retirement. And if you do decide to withdraw that money before you retire, the government penalizes you for doing that. There are exceptions, of course, such as the first time home buyers plan, a special plan that's available to you if you are having RSP account open and you contribute to it actively. So there are exceptions like that where you can access that money without having penalty. But generally speaking, this is how it works. The next option to reduce your taxable income applies to people who are self employed or who have some sort of side hustle that brings them in income. You can be a soul cycle instructor doing part time cycling classes outside of your work. You can have an Amazon side hustle. You can be a makeup artist on the weekends, etc. Any form and shape. You get the point. So, if you are a person like that, the next way to reduce the income tax would be to ensure that you earn as a business and not as an individual. Why does that matter? That matters because individual tax rates and corporate tax rates are different. And here in Canada, they differ vastly, and it has a very big impact on how much money you're left with after you pay taxes. Imagine you're a makeup artist in Vancouver, BC. Even though you are an individual providing service to your clients and doing makeup for them, you can set up a company, register that company, and have the money come in not to you as a person, as Sofiia, the makeup artist, but to a company, Sofiia Incorporated, let's say. Back to the example of $60,000. If I'm an employee, again, if I'm earning as a sole proprietorship or I work for a company, I will be taxed at that 28.2% rate, and I will be losing or giving away to the government close to $15,000 in taxes. At that rate, if you earn $60,000 a year, and if that's the revenue stream that you use, you are left with $46,506 after paying taxes. However, if you are a makeup artist who owns a company, Sofiia Incorporated, Sofiia Makeup Incorporated, you and earn $60,000 annually, your combined corporate tax rate is only 11%. So that includes both provincial and federal. I won't break it down and go into details. The total is what matters here, 11%. Meaning that after paying that tax rate, and it's again done by tax brackets, you are left with $53,400. There is a big difference, almost $6,000. If you're running a corporation, you are also able to write off business expenses such as makeup kits, brushes, your office lease, and so on. And that would bring your taxable amount even to a lower dollar quantity, meaning that then you will be paying even less tax. One thing to keep in mind is that if you do decide to pay yourself a salary, you'll be subject to those individual tax rates again. So, as long as you keep this money in the company and you write off your business expenses and you invest through the company account, you will not be subject to those rates. If you do need to pay yourself a salary, though, one thing to keep in mind is to make sure that your salary stays within a lower tax bracket. And finally, the third and final way to reduce your tax bill and pay less tax, legally pay less tax, is by earning the money through income streams that the government does not tax on. Now, you're probably thinking, Sofiia, what is this type of magic? I didn't even know that is possible. I'm here to tell you that vehicles and mechanisms like that exist, especially in Canada. And one that is the most easily accessible is a tax free savings account, an account in which you can invest your after tax dollars and let them compound and grow. But once you decide to take the money out of that account, you will not be taxed on those capital gains and growth that you have accumulated over the years. An equivalent of a TFSA in the US is a Roth IRA. Again, if you're in countries outside of Canada and the US, please make sure that you know what an alternative solution to you is and be careful with that. For anyone who is just starting to invest, I think TFSA is a great option to begin and a great idea to maximize those annual TFSA contributions before you invest in other accounts. You're new to investing, stay tuned because this year in Her Wallet is finally launching its membership to an educational platform for women, and that's going to include learning how to invest as well. I really hope that you can check it out. So, today I went over three most common and easiest ways to reduce your tax bill. This is just the surface. There are many more options available, but I thought, you know what, we're just going to start with these three. If you liked this episode, please leave us a comment, a like, a follow, share it with your family and friends, leave us a review on Apple. Anything helps us grow and reach more audience. I thank you all for your time. And as always, I'm going to ask you to give yourself credit for showing up for yourself and your future because every time you increase your financial knowledge, you increase what's financially possible for you. Thank you all and see you next week.